Welcome to this guide where we are diving into the volume profile indicator. By the end of our time together, you will not only understand what the volume profile indicator is, but also how to make it work for you in your trading. You will learn how it can help you spot important price levels and make better decisions. Get ready because there is a lot to explore here, and you are in for a deep and practical lesson. Imagine being able to look inside the market and see exactly where traders are most interested. Picture understanding not just when trades happen, but the precise prices that attract the most buying and selling. That is what the volume profile indicator offers, a powerful way to visualize the market's activity in a whole new light. Now let us begin with the basics. What exactly is the volume profile indicator? Well, think about it as a special tool that shows you how much trading activity has happened at each price level. It is not like those usual bars you see that tell you how much volume was traded during a specific hour or day. Instead, it looks at each price level, giving you a better picture of where traders are really active. It is like looking at the market in 3 dimensions, where you get to see which prices people are excited about and which ones they are not paying much attention to. Now, while we are talking about trading activity, let us dive deeper into some key chart patterns that often work well with the volume profile indicator. These patterns can help you recognize potential moves before they happen, giving you a big advantage. For instance, one classic chart pattern to consider is the double top or double bottom. When price reaches a high volume node and forms 2 peaks or 2 valleys, it can often signal a reversal. If the volume profile confirms that these peaks or valleys align with high trading volume, it strengthens the potential for a price change. Another important pattern is the head and shoulders pattern. This is a reversal pattern that shows up when price forms 3 peaks, with the middle peak being the highest. If the head of the pattern is aligned with a high volume node and the shoulders show declining volume, this can be a sign that price is losing momentum and a reversal might be coming. Volume profile helps you see where most of the activity is concentrated, giving you more confidence in identifying this pattern. You should also be on the lookout for flag and pennant patterns. These continuation patterns occur when there is a sharp price movement, followed by a consolidation period that resembles a flag or a triangle. If the consolidation happens around a high volume node, it often means that traders are accumulating positions before another big move. Volume profile can show you how active the area is, helping you anticipate when the breakout will happen. Finally, the wedge pattern is another powerful one to keep in mind. Whether it is a rising wedge or a falling wedge, these patterns often indicate a potential breakout. When a wedge forms near a low volume area, price can break out quickly since there is little resistance holding it back. Combining wedge patterns with volume profile gives you an extra layer of insight, allowing you to spot potential opportunities sooner and with more confidence. By integrating these chart patterns with the volume profile indicator, you will be able to better understand market dynamics. Whether it is a reversal, continuation, or breakout, volume profile can give you an inside look into the behavior of traders at key price levels, making these patterns even more reliable. Imagine this. You have a price chart in front of you, and along one side of it is a sort of histogram. That is the volume profile. It is telling you where buyers and sellers have been the busiest. If you have ever felt unsure about where to enter or exit a trade, this could be what helps you make those choices a little clearer. Now that you know what the volume profile indicator is, let us look at how it actually works. Picture that histogram showing the volume along the side of your price chart. There are some price areas where you see a lot of volume. Those are called high volume nodes. These are spots where the market has spent a lot of time. People agree these prices make sense, so trading happens there again and again. These high volume nodes often act like magnets, pulling the price toward them. They can be great areas to look for support or resistance because buyers and sellers are both interested at those points. It is also helpful to understand how high volume nodes interact with different chart patterns. For example, high volume nodes often coincide with key levels in patterns like double tops, double bottoms, and head and shoulders. When you see a double top forming at a high volume node, it reinforces the potential reversal as the market has tested that level twice with substantial volume. Similarly, in a head and shoulders pattern, if the head aligns with a high volume node, it adds weight to the idea that this price level was significant and a reversal might follow. In continuation, patterns like flags and pennants, high volume nodes can signal areas where traders are accumulating positions during the consolidation phase. When a breakout eventually occurs, it is more likely to be strong if the preceding consolidation happened around a high volume node. This suggests that traders were actively placing their positions in anticipation of a big move. Another useful pattern is the wedge, either rising or falling. When a wedge forms around a high volume node, it can suggest that price may continue to oscillate in a narrowing range until enough buying or selling pressure accumulates to push it out. The presence of a high volume node makes the breakout from these wedges even more impactful, as it means a lot of traders were interested in this price range before the breakout. By combining volume profile with these chart patterns, you get a much clearer picture of the strength and potential outcome of the patterns. High volume areas can act as confirmation points, enhancing your confidence when you spot a familiar pattern setting up around these nodes. On the other hand, low volume nodes can help you recognize where price is likely to move quickly, which is crucial for breakout trading strategies. On the other hand, we also have low volume nodes. These are price areas where not much has happened. The market has barely spent any time there, and you will see that reflected in the low volume. Price tends to move through these areas really quickly. They are like shortcuts, zones that do not slow price down very much. When price gets to these low volume nodes, you might see a fast move because there is not much keeping it in place. All right, now let us talk about a few key parts of the volume profile indicator. One of the most important pieces is something called the point of control. It sounds fancy, but all it means is this. It is the price level where the most volume has been traded. If you think about it, that is really important. This is the price where buyers and sellers agreed the most. The point of control can act as a kind of center of gravity for price. When price gets close to it, it tends to stick around for a while. There is also something called the value area. The value area is the range where roughly 70% of all the volume took place. If you want to know where most of the trading happened, this is the place to look. The upper and lower boundaries of this value area are called the value area high and value area low. These are important because they often act as strong support and resistance levels. When price gets near one of these levels, it has a good chance of bouncing back or breaking through, which is a big help if you are looking to make a trading decision. Now let us expand on how chart patterns interact with the value area. When a double top or double bottom forms near the value area high or value area low, it can act as a very strong signal of an impending reversal. The reason is that these levels represent areas of significant trading interest, and the market tends to react strongly when revisiting these boundaries. For example, a double bottom forming near the value area low can indicate that price is finding strong support, potentially leading to a reversal upwards. Likewise, a double top near the value area high can suggest resistance, signaling that price may soon drop. In the case of a head and shoulders pattern, if the head forms around the value area high, it often means that the market has reached a significant resistance point and a reversal is likely. The value area boundaries serve as additional confirmation that price has struggled to move past these levels, and a turn in direction may be imminent. Continuation patterns like flags and pennants can also benefit from the context provided by the value area. If price breaks out from a flag or pennant and re-enters the value area, it is often a sign of renewed strength. Traders can use the value area boundaries to gauge whether the breakout is likely to be sustained or if price will pull back. The wedge pattern, whether rising or falling, also gains additional meaning when it forms near the value area high or low. A falling wedge that reaches the value area low can indicate that price is poised to reverse upwards, especially if there is an accumulation of volume at that level. The same holds true for a rising wedge near the value area high, where a breakout downwards can be expected. By understanding how these chart patterns align with the value area boundaries, you can add more depth to your analysis. The value area provides context for where the market sees fair value, making it a key reference point when assessing the validity of chart patterns and potential trading opportunities. Let us talk about how to read the volume profile and use it effectively. The main thing to remember is that the relationship between price and volume tells you a lot. The more volume traded at a certain price level, the stronger that level is. Think of those high volume nodes as anchors in the price chart. Price likes to hang around these levels. If price is approaching one of these high volume areas, it may slow down, reverse, or pause. That can be a good opportunity to think about entering a trade. When price hits a low volume area, the story is different. It might fly through without much resistance. These low volume nodes can give you hints that a breakout is on the way, especially if price is leaving a high volume area and heading toward a low volume one. Breakouts can be quick, and being ready for them can make all the difference. Now, how can you actually use the volume profile in your trading? One of the most common uses is for finding support and resistance. Imagine price moving up toward a high volume area. That area could act as resistance, causing price to stop or turn around. On the flip side, if price is falling and comes toward a high volume area from above, it could act as support, causing price to bounce back up. These levels are places where you can find opportunities to make well-informed trading decisions. Another way to use the volume profile is for breakout trading. Low volume nodes are great for this. If price moves out of a high volume area and into a low volume one, it often speeds up, creating an opportunity for a breakout trade. Think of these areas as doors. Once price moves through, it has the potential to make big moves without a lot of resistance. For those who prefer range trading, the point of control and the value area boundaries are often key. Price tends to move back and forth between the value area high and value area low, and it can be helpful to think about buying near the low boundary and selling near the high boundary. Now, let us talk about setting up the volume profile indicator. First, you need to decide on the right time frame. Volume profile works on any time frame, but the one you choose should match your trading style. If you are a day trader, you might use 5-minute or 15-minute charts. If you prefer swing trading, daily charts may be more your speed. The key is to pick a time frame that matches how you like to trade. In addition to selecting the right time frame, it is also important to consider how chart patterns play out across different time frames. For example, a head and shoulders pattern that forms on a 5-minute chart may indicate a short-term reversal, while the same pattern on a daily chart might suggest a more significant, longer-term change in trend. Understanding how these patterns fit within the context of the volume profile on different time frames can help you determine the strength of the signal and whether it aligns with your trading goals. Another critical aspect is to use multiple time frames to gain perspective. By analyzing a larger time frame, such as a daily or weekly chart, you can identify significant levels of support or resistance based on high volume nodes or value areas. Then, zooming into a smaller time frame, like a 15-minute chart, can help you pinpoint entry and exit points more precisely. This technique, often called multi-time frame analysis, can be particularly effective when combined with volume profile because it allows you to understand both the macro and micro perspectives of market activity. For instance, if you identify a high volume node on a daily chart that coincides with a bullish flag pattern on a 15-minute chart, this could provide a high probability trading opportunity. You are using the broader market context to guide your decisions while fine-tuning your entries with more detailed analysis on a shorter time frame. Similarly, if a low volume area appears on both the daily and 5-minute charts, it might suggest that price could move through this zone quickly, presenting a potential breakout scenario. By combining different time frames, you gain a more comprehensive understanding of where key levels exist and how they align with current price action. This approach can make your trading more robust, as you can filter out weaker signals and focus on opportunities where multiple factors come together. Next, you will need to set the range of your volume profile. You can focus on a single trading session, a week, or any custom period you want. This is up to you, depending on what you are looking for. It is all about getting the data that makes the most sense for your strategy. Most trading platforms let you adjust how the volume profile looks. You can zoom in on certain parts of your chart or change how detailed it is. Try different settings to see what works best for you and makes the most sense for what you are trying to learn. Let us now look at combining volume profile with some other indicators. Volume profile on its own is powerful, but it works even better when you use it with other tools. Moving averages are a great example. If price is above a moving average and near a high volume node, it is a good sign for a long trade. It is a way to confirm what the volume profile is already telling you. Another helpful tool is the Relative Strength Index, or RSI. If price is near a high volume node and RSI is telling you the market is overbought or oversold, it can help confirm a reversal. It is like getting two signals pointing in the same direction. The moving average convergence divergence, also known as MACD, is great for confirming momentum. If price is near the point of control and MACD shows increasing momentum, it could mean a breakout is about to happen. Using these indicators together can help you feel more confident in your trading decisions. One of the most important things to consider when using the volume profile is managing risk. Think about where you place your stop losses. You can use the value area high and value area low to guide you. If you are in a long trade, it might make sense to put your stop just below the value area low. For a short trade, putting the stop just above the value area I can help keep your risk in check. Also, consider adjusting your position size based on how far away price is from key volume profile levels. When price is close to strong support or resistance, you might take on a larger position because your risk is more defined. When price is in a low volume area or somewhere less predictable, you might want to scale back. Let us talk about take profit targets. High volume nodes make excellent targets because price tends to get pulled toward them. Think of these areas as natural points where price wants to go. If you are in a trade, aiming for the next high volume area can be a solid strategy. Let us go over a few common mistakes that traders make when using volume profile. One of the biggest mistakes is ignoring low volume areas. Remember, price tends to move fast through these zones, and they can provide great opportunities. If you overlook them, you might miss some of the best moves. Another mistake is relying too much on volume profile without considering other factors. It is a powerful tool, but it is best used alongside other analysis like trends or market news. Finally, do not forget to consider the overall market context. If you only look at the volume profile without thinking about the broader picture, you might miss important details that could affect your trades. Here are a few tips to help you get started with volume profile. Begin by analyzing higher time frames like daily or weekly charts. This will help you spot key levels that are important to the bigger picture. Once you understand these higher level areas, you can use smaller time frames to fine-tune your entries and exits. It is also helpful to set alerts for important levels. Many platforms let you set alerts for when price reaches a specific volume profile level, like the point of control or the value area boundaries. This way, you do not have to constantly watch the charts, and you can react when price reaches a key area. Finally, look for confluence. This means watching for when different tools give you the same signal. If a key volume profile level lines up with a trend line or a Fibonacci retracement level, it is often a stronger signal. When multiple things point in the same direction, it is usually worth paying attention. So, what have we learned today? The volume profile indicator can give you a deep understanding of where most trading activity is happening. This can help you find support and resistance, trade breakouts, or manage your trades within a range. Remember to combine it with other indicators for the best results. Keep practicing, and soon you will be using the volume profile indicator to improve your overall trading strategy. If you have questions or thoughts on this, do not hesitate to share. We are all here to learn and grow together. Keep exploring and refining your approach. You have got this.